Hi, this is James Shug with Westpac London's end of day report for Thursday, October the 6th. Two main events today to report. The first was the Bank of England, which announced an extension or a resumption of its asset purchase program or quantitative easing by a further £75 billion over the next 4 months. This is the program that they ran for just over a year between through 2009 up until early 2010, when they purchased 200 billion worth of bonds off the market as a means of adding further stimulus to the economy, given that they'd already cut interest rates at that stage down to 0.5%, which is where they remain today. The bank said that it was, and this is mirroring arguments we've been making for some time now. The Bank of England said that severe strains in funding markets, rising unemployment, a stalled economy for 3 quarters now, and deep concern about Europe offset temporary concerns about the well above target inflation rate, which in 2 years' time the bank now assesses will likely be below the 2% target. Now, as I'm speaking to you, Mervyn King is being interviewed on Sky here in London, and he's saying that this could be the worst financial crisis ever, and that justifies the aggressive policy stance that they've adopted today. On the other hand, the European Central Bank left interest rates unchanged at 1.5%, despite Trichet in his last press conference following an ECB council meeting, despite acknowledging intensified downside risks to the economic outlook. They kept their assessment of risks to inflation as broadly balanced, however, and that could be one reason why they decided to leave interest rates unchanged today. However, they did introduce a range of non-standard measures, or reintroduce them actually, another 40 billion worth of covered bond purchases to keep that market liquid, and a whole range of liquidity measures, including unlimited funding at the regular refinancing operations and year-long funding available too to banks, to try and provide an offset to the freezing up of funding markets that's beset European banks because of concern about their sovereign debt exposures. So they're the main two events really to report on. There was some economic data today, including German factory orders, which fell for the second month running in August. That's the first back-to-back decline, July and August, that we've seen for orders there since the early part of 2009, which is a worrying signal for the German economy. We had in the US weekly unemployment figures, which showed a modest rise. We had expected a bigger rise, given that the very steep fall in claims that we saw last week had been said by the Bureau of Labour Statistics to be due to a statistical distortion rather than genuine. So it does look like maybe on that indicator at least, the labour market may not have deteriorated that much in the month of September, in contrast to the message we were getting from claims figures earlier in the month. That latest weekly result, though, comes after the period of the survey for September payrolls, which of course is out tomorrow. That's the monthly jobs report in the US, which we do think will be quite weak. We're looking for only a 30,000 increase in payroll employment to be reported there. So that will be, if we're right, further evidence that the US economy really is struggling at the moment. So given that, I may as well just jump straight into the markets. As you'd expect, they're doing pretty well at the moment. Equity markets in London, for example, up 3.7% heading into the close. It's 5:15 now in London. The French market's up 3.4%. The German market's up 3.1% today. Basically, what we're seeing is equity markets responding to policymakers at last being seen to be doing something about the huge problems that are confronting the major Western economies. Okay, the ECB didn't do as much as the Bank of England, but by citing intensified downside risks, that could be a signal that the ECB might be inclined to cut rates as soon as next month. Moving on to US markets, the Dow's currently up 0.75% at 11,023. Commodity markets have done pretty well today as well. We've got Copper prices, which have tumbled over the last couple of months, up 5%. Crude oil's up 1.2%, back above $80 a barrel at $80.63. And gold prices are modestly higher as well, up 0.25% at $1,645 an ounce. Aussie dollar, it's benefited too from the policy action we've seen today. It's risen to 97 cents against the US dollar. Actually, it was closer to 97.5 earlier today, but continuing its grinding higher of the last few days as we've seen policymakers start to do something about the problems. I think markets and investors are still hugely concerned about the risks confronting the Western economy. There's still potential for more losses ahead, particularly if we see more bad news, and the ongoing concern about the Greek debt position remains a keen focus, with some reports coming through today suggesting that Greece could be even closer to a debt restructure than perhaps we've been led to believe up until now. Still reason to worry, but at least we're getting a policy response. Important jobs figures to watch for in the US tomorrow, and I'll speak to you again then.